Welcome to this new series of webinars. It's the first of a three-part series on how to use infraMetrics, which is our infrastructure data platform for investment. And I'm joined during this whole series by Abhishek Gupta, who's here with us. Hi, Abhishek.
Hello, Frederick. Good to be here with you.
And for the first of these series, we're going to talk about comps or comparables, which is a topic that comes back a lot. And I think Abhishek, in all the different client discussions and other calls that he's been on, has been talking about comps and hear about comps quite a lot. So Abhishek, why is that? Why is comps such a big topic?
Yeah, I mean, we have spent quite a bit of time discussing that as well. I think it's the nature of comparing your investment with the like ones, and that's a very natural thing to do. It's common in equity and real estate, so obviously people tend to think that why not for infrastructure, and that often triggers that discussion. So if you're thinking about an investment, you try to find what's similar out there, you try to see what value it is trading at, and try to infer what could be the value for your investment.
That's right. And then there's always this question of how to find the best comp, the closest comp, the most granular comp. So I think we're going to talk about this a lot today because that's kind of the crux of the matter. First, very briefly, infraMetrics today, it's a platform that's widely used in the industry. It's $400 billion of infrastructure AUMs. We are now an index provider recognized by ESMA, so that's part of the platform or the indices that we produce. We produce also investment analytics for a whole bunch of, in fact, hundreds of segments, and we'll talk a lot about segments today and what's the right segments to build the right comps. And we also provide now, or as of the next couple of days, literally, asset level data. So line by line data, which is also a way to build analytics and research. And of course, we also produce all this information on a customized basis, customized indices for funds, for various portfolios, position keeping solutions, etc., etc. So won't spend too much more time on this. I think this is something that our colleagues discuss at length. The agenda for today. First, why comps matter. Why are we talking about this? Because we are typically known as the benchmark guys. I think that's how people like to refer to us. So what do we want to talk about that? And I think because it touches on something very fundamental, and in the end, you'll see it touches on benchmarking. And then I'll try and discuss what it means to find good comps. And this is a little bit tricky. You need to navigate these different dimensions of fundamentally of a statistical problem. But I'll try and come up with some clear and simple guidelines to do that. And then Abhishek will talk about two cases. First, when comps don't work. And I think he has some good examples of how if you have the wrong approach, you may even have the right data, you have the wrong approach to comps, then you're going to get the wrong numbers. And then how to do this better using infraMetrics and why. Okay, so first, maybe before even starting, I just wanted to highlight the notion of comps itself. What is it? Because if you think about it, a comp is just one asset, usually it's one single comparable transaction. That's usually what you're after. So you're trying to buy an airport, say, and you look for another airport that looks roughly the same, and that's your comp. But of course, ideally, you get more than one. This is what this is all about. But as soon as you get more than one, you're not really just comparing assets between themselves. You're comparing one asset with a combination of other assets, and ideally, as many airports as you can get your hands on, as many information as you can get your hands on. And hopefully, to get a view of the average airport or the average type of airport that you want to invest in, you need to get a whole lot of data and even more data, right? So the more data you have, as long as it's about the same kind of investment, the happier you are. And so in the end, you're looking at an average. And this is quite an important point because it means that building comps is really about the law of averages. And we'll come back to that. How to pick the right average. Now, before going into why comps really matter, I want to do a little poll. So Natalia, could you please start the first poll, which is the following question. For your infrastructure investments, do you use DCFs, comps, or both? Now think about it carefully. Let's see. That's right. The poll has started. So I'm going to give you a little bit of time to answer this. I see we have a raised hand. I forgot the bit where I say that if you have questions, you should put them in the question and answer window, please. And we'll look at these at the end of the webinar. Okay. So looking at, okay, I'm getting a decent sample of answers. Couple more seconds, come on.
This is turning into a very interesting result, isn't it?
Mm-hmm. All right. So I have, Natalia, I think you can stop it and share it. Can you do that? There you go. So I hope you can see the results. We only use DCF 26%. We only use comparable yields 6%. That's almost, it's very few people. And in fact, we use both 70%, almost 70%, 68%. Now that's interesting. And I'm glad to, so this is a very good batch of students that we got today because the majority got the right answer. So let me try and explain this a little bit. The problem we have with infrastructure and comps is that when it comes to pricing ratios or also yield, IRRs, etc., it's quite difficult to find. We have too few comps in the cross section, right? So infrastructure companies are quite different from each other. It's difficult to find assets that look alike. We also have too few comps in time because infrastructure is very liquid. So assets that look alike and that trade at the same time or in a short window can be quite difficult to come across. And then the data itself is where it's usually quite poor and it's often biased because it comes from contributed data sets, which have those typical biased characteristics, survivorship bias and selection bias, meaning that we don't get the right comps from a lot of the contributed data. So if you start from there, you might think, okay, well, we don't use comps. And that's actually probably why we had such a low level of answer to the second option. Now, yes, comps are hard, and that's why we use DCF, the income method. Alas, I'm afraid that DCF is just another form of comps. And I think that's what the 70% of people who answered the third option actually got. Of course, DCF requires finding comparables as well. You just need to find a comparable discount rate instead of finding a comparable price or price ratio. Using DCF or price ratio, like EV to EBITDA, boils down to the same problem. So in the end, we can't escape this problem of comps. Even though finding equivalent price ratios, it's tricky for infrastructure companies. It's equally tricky or it's equally difficult to do for discount rates, right? So what are we going to do? Well, the first question is, why do we really want to use comps? And often, or sometimes at least, the answer is, well, because we're trying to find the one true price of asset X. And I think the philosopher would reply, well, no, not really. Because that would imply that either asset X is exactly the average asset. So go back to my picture with all the airports and the average airport, or all the assets are exactly the same. Because if we know the assets are heterogeneous, using comps is not going to give us the true price of our asset. Never, almost never, right? Because our asset is not exactly the average asset and not all assets are exactly the same. So what are we using comps for? Well, we use comps as a benchmark to make sure that we're that we are buying or selling an asset within the bounds of where the market is at. There we go. We're the benchmarks people. Again, that's us again. Because what we want to know is for that kind of asset, keyword here, what's a kind of asset or class of asset or category of asset for that level of risk, in fact, Are we looking at a price or a rate of return, which makes sense given where the market is at today when we're buying or selling? So for example, if 25-year solar in Europe trades at 5% yield, just as an example, that's the average market price, okay? Maybe your asset, your solar project is like the average asset, but probably it isn't. If it's not, it remains very unlikely to be traded in the same market at a completely different yield or multiple, okay? So in the end, the market is at a certain point, that's the average level of, say, yield or pricing in the market. And however special or however different or idiosyncratic your asset is, you're gonna have to, at one point, hold your hat, hang your hat rather, to the market reference, okay? And that's because in the end, when we talk about investments, even investments in illiquid long-term infrastructure assets, we're talking about relative value. And we're talking about arbitrage. We're talking about whether you should invest in this asset or that asset. And also between investing in this asset class or that asset class. So we absolutely have to have a point of reference. In other words, a benchmark, even if we do not have a comparable set, which gives us the exact value, right? In other words, there's no escaping the requirement to compare bid prices or NAVs to other investments in order to understand what to do about them, to buy, hold, or sell, so to make any kind of investment decision. Okay, so that's why comps matter. Now, it remains difficult to find good comps, as we've said at the start. So here I want to highlight the fundamental problem that we have and try and propose some guidelines to do it right. Because fundamentally, we're trying to trade off two things. We're trying to trade off granularity and robustness. So let me try to explain. First, let's have a little survey. How many data points would you say is enough to get good comps? So Natalia, can we please have the second poll? Either 5, 10, 50, or 100. All right, so I see here that the crowd is also zeroing on one particular type of answer. However, unlike the first case where you all got the right answer almost, here I'm afraid you're all gonna get a bad mark. But all right. Natalia, can you please stop and share this poll? Thank you. All right, so 20% said 5 data points, 53% said 10, another 20% said, or 19% said 50, and 8% said 100. Enough data to get good comps, right? Right, so that's, I'm going to say this is informed or constrained by what people actually have been able to do today in terms of data, but I'm afraid it's not quite good enough. So let me try to explain. So we're going to have to try and figure out what to do between granularity and robustness, right? On the one hand, we want like-for-like comparisons. So we have to be as granular as possible. We want an asset that looks as much as possible, as much as to our asset, sorry, as much like our asset as possible. But we also want to have a meaningful comparison. We want a statistically robust number. Otherwise, I'm afraid it doesn't need very much. So I'll try to illustrate this in a second. But to make intelligent investment decisions, we need a number that means something. But we also need a number that is a fair comparison, a like-for-like comparison, which is pulling, these two requirements are pulling in two different directions. Okay, so let's take an example. Let's say we have an investment that has a true market EV to EBITDA of 12 times on average today. That's the true average market value because that's where the market is at. But we can't see this, of course. And also this can vary because these assets are all different. They all have different points in their life cycle. They all have various idiosyncratic characteristics. And so this EBITDA can vary between minus 50x to plus 100 times between all these different assets. But for this category of assets, the true value is 12, okay? We don't know the average, but let's try and find out by looking at some recent transactions. So what I'm going to do is take some normally distributed data with a mean of 12 and a standard deviation of 20, which means that I'm going to go kind of roughly between minus 50 and 100. In reality, guys, it's not that easy. The real world is not necessarily distributed like this, but you know, if you have enough data, it tends to be. And let's get 10 data points for this distribution, right? So we take 10 data points randomly. So these are 10 recent transactions that we happen to come across because our consultant had that in their database, or these are the numbers from our clients or whatever, with maybe our own deals. And as you can see, you get a very imprecise estimate of the true value because you get a mean of 3.18 when the true value is 12. Okay. So maybe we could improve this by collecting a little more data. So if we get 12 data points, so we just had 2 more data points and that we observe randomly, we get a completely different picture. Now we get a ratio of 19.9, but the true value is still 12. So it's still completely weird and completely wrong. And that's because 10 is not robust. Neither is 12, by the way, neither is 14, neither is 15. And that's just the nature of statistics. And again, this is data that is nicely distributed. It could be that in reality, there are some extreme values that would make this even harder to achieve. Of course, if you get 100 recent deals, you don't get the right number. You get a mean of, so here I'm selecting 100 data points randomly. I get a mean of 11.13. So it's not quite right, but it's a lot closer to the truth. And what happens if I add 2 more data points? I get 102. Well, I get pretty much the same thing. I'm a little bit off still, a little bit more, in fact. So I have a bit more data, but it's a little bit more, sorry, a little bit closer actually to 12, but it's still not, it's still pretty close, right? So it doesn't really make a big difference to have 2 more data points. The point here is these 2 types of data sets have completely different implications. When you have a small data set, the order of magnitude of the error compared to the large data set is several times larger. We're not talking tens of basis points. We're talking hundreds of thousands of basis points of difference in the error. So having 10 data points, having 15 data points is I guess all very nice. And I will show you some examples in a minute where it can be useful if there really are the right ones. But in general, it could really lead you astray, or at least give you information that's completely useless. The other key thing to remember here is that there is a threshold effect of having 100 versus 10. And so adding 5 data points or 10 data points is not quite enough. You need to add a lot more. So having access to a much larger data set makes a big difference in terms of robustness and makes a big difference in terms of the quality of the comparables that you will eventually achieve. And so this is important. 50 is not 100, it's not 15. It's quite different. Okay. So that was robustness. Finding robustness is fairly easy to understand. Okay, you need more data and you need the minimum amount of data. Now, granularity, that's the sort of opposite problem. The appeal of granularity comes from our desire for a fair comparison, right? A like-for-like comparison. And in some asset classes, it's fairly easy to achieve because assets are quite homogeneous. So in real estate, you could compare 20 or 50 shopping malls, ideally 100 shopping malls, and they're really quite similar. So the granularity is quickly irrelevant, in fact, as long as you're looking at the right type of asset, because they're all a bit the same. They're mostly the same. But with infrastructure, it's the opposite. By definition, they are very, very different. They're all in a completely different location. By definition, you can't have one just next door because that's why you build infrastructure. Usually it's because you only need one in one place. It's only used for one thing. The design is often different. They each have a different contract, etc. So they have, unlike real estate, many, many reasons to be quite different from each other. And so, for instance, you can be looking at a stadium, you could be looking at a water reservoir, or you could be looking at a container port. What do they have in common? You might say, well, not very much. So super heterogeneous. So how do we get granular when we have a limited amount of data and when every asset are all completely different? Perhaps one extreme cases is this one that I quite like. It's the Dogger Bank wind farm in the North Sea. It's a very unique asset. It's one of the most remote wind farms. It's built on a sandbank in the middle of the North Sea. And if you invested in this asset, you might well say, well, this is one of a kind. And what am I going to compare this to? There's nothing I can compare it with. Okay. So let's think about this again. What does it need to find granular comparisons for infrastructure assets? If you're looking for an asset that's exactly like yours, clearly you're doomed almost by definition. You will end up with a comparator of one, which is your own asset, because your own asset is super unique. So what can you do? You can either give up on comps, okay, well, I can't compare this to anything. But that's really not ideal, because then we're going to lose the ability to understand how we're pricing this asset relative to the market. Or you could try and think again about what you're trying to achieve with those comps, which is really a benchmark. So the point of reference of where valuations for that type of asset is at, that is both granular enough and robust enough. Okay, so let's try and do that. But first, I want to drive this point a little bit more. So I'm going to take an example from the education space, because I think this will speak to a lot of us. I think most of us on this webinar have children or have been around children. So instead of looking at the market, I want to look at finding granularity at school. As an example, okay? So let's say you have kids, you know that each child is unique. Each child is very idiosyncratic, especially your child, just like your infrastructure asset, okay? But you also know that knowing how they're doing in school relative to the other children is very important, because however unique they may be, one day they'll be competing in the job market against all these other people. And so you need to know now today, because maybe they need to work hard or they need to change school or whatever, how they're doing. It's really important. So their performance is of interest relative to others, despite the fact that fundamentally they're very unique. And so what drives their performance might not be easy to compare with other kids. So how are you going to compare your children's math results? Are you going to compare them to all the children in the world? Probably not. That's probably not a good set. Your neighbor's children. No, not me. I wouldn't do that. A group of kids passing down the street, or whoever is on the ping pong team that your kids are in, or the cello ensemble. So for example, this is a photo of my daughter at school, rocking a cello. And of course, she's very unique and idiosyncratic. And so maybe I could tell her, look, I'm going to take all these other kids who are with you on stage. You all look the same. You all have the same height. You're in the same clothes. You all have a cello. And I'm going to take them as a point of reference for your math results. I'm going to evaluate your math results relative to them. Do you think she would think it's fair? I can tell you already, she would think it's not fair. She would, you mustn't compare me to them. You must compare me to other people, but not them, because they're good at music, so they're very good at math. So that's not fair. What I'm trying to get to here is that it doesn't matter how unique the children are. What we want is a fair benchmark. Okay, so again, think about infrastructure assets. And a fair benchmark in this case will be what you compare kids who are in the same school system, you compare kids who are in the same age group, etc., etc. So you try and build a sample that is that has the key characteristics, that has the common characteristic that all these kids have, so that you can make a fair comparison. So, which kind of begs the question: what are these segments that are important to make a fair, meaningful comparison? And we'll come to that for infrastructure. If you want to make a representative comparison as well, not only do you need to put them in the right box, in the right category, but also you need a large amount of grades, because if you just have a few grades for a few kids, it's obviously not fair. And then you can ask your child, they'll tell you, right? So if you look at the grade point average for some schools, you want to have at least 100 candidates, and you want to be focusing on the type of classifications, the type of subjects that are the most important to to succeed later on, for example, to go to university. Okay, so back to infrastructure. I think you get my point. It's just that it's that much clearer when you look at children. Granularity has its limits. Okay, it's important to have a granular set, but you can't achieve everything with granularity. In fact, there is such a thing as too much granularity. If you want to go too granular, you end up with lots of noise, and a lot of noise is not going to help you make a fair comparison. The way to remove noise is not to become more and more and more granular and have more and more and more smaller and smaller and smaller set of comparable deals. The way to remove the noise is to use the law of averages, to use a large sample. And then again, it has to be the right large sample. So we want granularity to achieve a fair segment to compare to a representative set of common characteristics, right? So these are my guidelines to try and get the right comps, and then I'll let Abhishek show you how it's done. So we want to compare to the right common characteristics. So for this, we need a classification system. Okay, so we happen to have one called TICS, but that's not the only one that you can use to slice and dice the information in order to fall on the right type of data. And then we also want robustness, right? So again, so now you know that, so that it's not a few random observations that drive the results. So we want a minimum number of data points in each segment, ideally more than 50, preferably more than 100. Okay. And now you have this in mind. You have this trade-off between robustness and granularity. The way to decide how to make this trade-off depends on your use case. If your use case is to look at a portfolio, then the law of large numbers, the law of averages, will dominate the results. So that plays in your favor. You can have less granularity as long as you achieve, you find a segment which is representative of the portfolio as a whole, then you can focus on robustness and have more data. So we have an example like this to show you. If you're looking at individual assets, you have comparing individual assets, for example, several individual assets, you can be more granular. You have to be a bit more granular, but you mustn't be too granular. Otherwise, you're going to lose, again, the signal element and have just a bunch of noise. And for this, having the relevant classification of common factors, of common elements that drive the performance or the price of each of these assets is very important. And finally, you could be looking at just one individual asset, so not not a big portfolio or not a set of 5 or 6 that you need to pick between, but just one. In this case, you need to be very granular, of course, but it's very hard to find data that is really quite like that asset. And here you need to have the right sort of database with the right sort of filters. We'll also show you an example of that. So that's my part on trying to highlight the dichotomy between robustness and granularity. And now I'll let Abhishek describe how to actually implement this using some data. So Abhishek, your cue.
Thank you, Frederick. And welcome to all of you from my side as well. So far you have learned a lot of things, right, about comps, that how it's challenging to find the granular data, how you have to be careful about robustness, not just about granularity. So this is the first example that we wanted to take and show you that if you just look at some of the recent transactions in infrastructure to value your asset, to compare your asset's worth, it's going to be a very challenging task. So for this purpose, we have taken a reported transaction from last year. It's an Italian road with a merchant business risk. And in the left table, I have some financials for this road as well. Total assets 21 billion. So it's a very large road, very high levered, negative profitability. And we have a price and reported EV/EBITDA for this transaction. So this all comes from the reported data that we have collected. Now, if you wanted to compare a deal like this to some of the recent transactions, you would try to look at similar geography, you would try to look at similar time frame. So I've collected the data that's available with the price information, and I found these 4 transactions over the 1-year period from the time of this transaction. So there are quite a few challenges, first of all, before we even discuss the results. First, the reported transactions can be a mixed bag. You don't know to what level can you really satisfy the likeness of your asset under consideration versus the comps. In this case, for example, the business is merchant of we are interested in, but the reported transactions are a mixed bag of these business risks. Second is about the time period. You don't know how long of time period to use to find these comps because the economic conditions change, the market evolves, and the deal itself takes quite a while before it closes. So what's the right time period to use? And it also may differ between different types of assets. Smaller assets may be easier to close quickly, but larger, more complex assets deals take more time. So the time period becomes an issue. And then perhaps the most important thing is the risk exposure. So, I mean, the reported transaction is 21 billion that we are considering, but if you look at the comps, nothing is even close to that comparable. We have a range of 180 to 1.2 billion, which doesn't even come close to the asset under consideration. So now these factors enhance the problem that what you're looking at is completely different from what you have seen in the market recently. And as a result, the valuation that you arrive at using these comps can be quite far off from the reported transaction. But there are many other factors as well. This is just to demonstrate that how difficult the task is to just look at something that has traded recently to find your valuation. And the key issue lies in the fact that infrastructure doesn't trade that often. So comps approach, like I mentioned at the start, it's more popular in equity and real estate. But here I'm showing you the number of deals in private equity, real estate, and infrastructure over the past 10 years. And one thing is clear that infrastructure has very few deals. In fact, it's 65% fewer as compared to private equity and real estate. So obviously, the type of similar transactions that you will see in the market are going to be much fewer. Now, to find the comps, you have to get granular. That's for the whole theme of this presentation. But as soon as you start to get granular, here I'm looking at the comparable deals in global toll roads and French toll roads in the chart over the past 10 years. Your number of transactions reduce even further. When you had 2,000 something transactions in global infrastructure, if you just look at toll roads, you have about 150 transactions per year. Now, if you split this further by geography, French toll roads, you have about 5 transactions on average per year. And that's a very small data set to really find something and start to look at then the risk exposure, the same type of leverage, the same type of size bucket, and so on. It gets very difficult to find the comps that you're interested in. And like Frederick was saying, you may end up with just one that is your own asset. You may not find anything that is even remotely comparable to your asset. To bring this point home, what I try to do is look at the infrastructure's heterogeneity, where the problem lies. So if you look at infraMetrics database, the number of French toll roads in the database is 10. So it's already considerably better than what you have in the market. You had 5 transactions on average per year, but for these 10 French roads, we have monthly valuations going back 15, 20 years. So now, if you want to use this for comps, it's already a much better data set, but there are quite a few challenges even within this data set. If you look at the TICS characteristics, they are quite different even between these 10 toll roads, and the risk exposures have a very wide range. So if you have to find something comparable from this 10 set of roads compared to your asset, it's a very challenging task. You need to look at different types of risks, different types of characteristics, and then try to see if the set of companies that you're left with, is it really alike to your asset? And then there's question of robustness. Will these results be robust in the sense that the estimate that you get, will it change quite a lot if you have 1 or 2 fewer transactions and so on? So it's a very uphill task, but definitely it's possible with infraMetrics, and we'll demonstrate this to you in this section. But before we get into it, just a quick word about infraMetrics. So some of you may be familiar. It's a platform where we provide data on infrastructure, going from benchmarks to fund benchmarks to some analytics about deals and valuations. And very soon we are going to launch a product that will look at individual assets. It will offer you financials, valuations, and some climate risk data as well on individual deals. So it really is a platform which can take you from the individual asset level to up to the benchmark level, whatever your use case is. And then using this data, we are going to show you 3 use cases where comps can be applied. If you have a more broader view about your portfolio, you may want to understand what's the right benchmark for your portfolio, what's the right valuation level, and so on. So that will be the first use case. Second is really about comparing different investments. So it's an investment selection exercise. If you have 2 options, what's the right one to choose? And third is about assessing individual deal, whether the price that you are offering is fair or where the other rest of the market is. And this is really the most tricky part. So if you see these 3 use cases and you think about the spectrum that we were talking about, the trade-off between granularity and robustness, these 3 use cases lie along the spectrum. So the first use case is really about finding the robust data so that you can really compare your portfolio against that robust data, and that's the representative set of the market. The second use case is a bit more granular, that you can start to think about just those 2 deals and what's relevant for them, what type of risk factors are relevant, how to compare those 2 deals, etc. And the third one, when you are interested in the individual deal, this is where you want the most granularity, and that's also one of the difficult things to do. So we'll go through each of these use cases and now. infraMetrics allows you to do that because we talked about the classification system that's important to have. So we have come up with this TICS classification system, which is now industry reviewed and academically sound. We have divided infrastructure investments into these 4 pillars. So 3 business risk, 8 industrial activities, 4 geoeconomic classes, and 2 corporate structures. This allows us to compare these common characteristics, which will be relevant to build these granular comps. So you can think about just one type of business risk and look at the comps in that segment, or do it across these pillars. But the other type of classification is also by risk factors in a way, because these are common risk factors across infrastructure investments. So you can think about creating comps using some measure of size, profit, leverage, and so on. And that allows you to find your comparable investments as well. And the key thing about infraMetrics is the sample itself. You need a broad sample to be able to find even the broad set or the granular set of companies that you are interested in. And infraMetrics has a universe of 9,000 plus companies in 25 countries, out of which we value 700 companies every month. So it's a very rich valuation data set that we use. And then we provide 400 plus segments. So combining these assets together, we have data of 400 plus segments that you can use, split by these TICS categories, geographies, and styles. So if you are interested in a metrics like EV/EBITDA, we have some numbers here. We have about 120,000 data points going back to 2000 year. So it allows you to slice and dice it in many different ways, and then you can use it to build your comps analysis. Now, addressing the use case 1 for portfolio assessment. So these are all real transaction data that I've collected to demonstrate the point. These are 5 wind farms across the world. They are of different corporate structure, different business risk. So it's really a diverse set of wind farms that we are looking at here. Just purely in terms of the characteristics, the TICS characteristics, the geography, and so on. We can also understand their financials. And here I'm showing you size, leverage, profitability of these investments, and then some valuation ratios. You can see that they cover a very wide range. If you look at size, it goes from 19 million to 5 billion. Similarly, leverage, profitability, they have a very wide range of these risk factors. And consequently, the valuation ratios for these 5 wind farms are very wide. So overall, individual assets are quite different. That's sufficient to say at this point. Now, if you want to find a benchmark for this portfolio or value this portfolio, you can think about finding a broad segment of the market that allows you to do this analysis. So the first thing is to select a representative sample from a large database. So here we have taken two segments from infraMetrics. That's global wind power, that is 74 assets. And second is Europe contracted wind power projects. So it's a bit more granular. You are focusing only on European assets of contracted type. That's the majority of the portfolio. And also project financed assets. That's also the majority of the portfolio. That gives you 44 assets in total. Looking at the valuation ratios, you know where the average valuation is in both of these segments. So if you have more of these segments, then you can compare a benchmark average across all those segments, and that will give you a benchmark average. But at the portfolio level, the first thing to note is that you had a very wide range between assets, and that sort of gets offset at the portfolio level. You see that the portfolio average has a very standard valuation ratios. You don't have 40 plus, 50 plus EVA, but then so on. So that's the point. And the larger number of assets you have in portfolio, the more they tend to offset each other. So that's the law of average again in play. And finally, if you have found your benchmark properly, if you have built your portfolio properly, then the valuation estimate or your benchmark is not going to be too far from your portfolio. Here, there's still 10 to 20% difference, but it's not crazy like 100% or 120% difference that we showed you earlier in the case of roads. So it's possible to arrive at a benchmark for your whole portfolio using this approach. So just to summarize, in the use case one, we have shown you that in a portfolio, individual assets can have very different characteristics, geographies, and risk exposures. But if you start to look at the portfolio level, these individual asset-specific characteristics, they tend to offset each other to a very large degree. The law of averages comes into play here. So high granularity at this point becomes less important. You want to compare your portfolio against a broad representative set of market. And finally, by choosing a representative segment, it is indeed possible to arrive at a robust benchmark for evaluation. Again, the point is not to find the exact valuation, but to find whether your portfolio's valuation is in line with the benchmark. And that's what this exercise allows you to do it. Just to demonstrate in infraMetrics, I talked about this data being available. So you can find these valuation ratios, you can find the quartiles and the full time series in the download section. It allows you to select these segments very clearly. So all this data exists today, and that allows you to do this analysis by hand directly. That brings me to use case number 2 about investment selection. Say we want to rank the opportunity. So you have two European project finance wind investments that you're comparing from 2021, and you had the opportunity to invest in one or the other. Now, as always, what we want is to have comps that are super granular. But even if you take the data from all the existing wind farm investments, creating that most granular data set can be very small, and also it can contain a lot of noise because, as I'm showing you in this little Venn diagram, wind farms financed in 2021, then European wind farms and global wind farms, if you try to combine all these different things, you get a very small sample left. Instead, what we can think about is these projects have a collection of common risk factors. They have same characteristics. So why not try to observe these common characteristics and create a larger sample that is robust and that can be sliced and diced in however you are interested in. So you take all wind farms and you look at what type of size buckets you can create, what type of maturity buckets you can create, contracted wind farms, and so on. So all sorts of splits that are possible by risk exposure and by characteristics. And then you can take the average of the mean of each of these segments. So that allows you to create, let's say, multiple benchmarks, and then taking the average of those benchmarks can get you closer to your individual asset. I'll illustrate this point now. So let's say we are looking at the average EV/EBITDA ratio since 2020, and by buckets of risk factors within the renewable segment. So one characteristic filter we have already applied here. We are only looking at renewable energy projects. And then we have created buckets of size factors. So we have different 5 buckets of size, mean EV EBITDA in each of them, profitability buckets, time to maturity. So that's essentially how long the contract lasts for each of those assets. So you have some buckets of time to maturity and then leverage factor. Now, what you have to do is if you are comparing an asset A against such a data set, the first thing to note is how many observations you get. Here you have 1,000 plus observations, so the data is quite robust to compare asset A against these buckets. And second is to map asset A, which bucket does it fall under within each of these categories. So if it is a medium-sized, mid-high profitability, mid-short time to maturity, medium leverage, these are 4 random things that we have selected. Essentially, what you have to do is say that you can map this asset to each of these categories and then take the average of that. It gives you an EV to EBITDA of 11.46. Now that's your benchmark, and that's representative because you have looked at that asset from risk factor exposure perspective. What you have said is, yes, this asset has certain characteristics, so we are going to find similar assets, similar renewable energy projects in the market. We are going to look at their valuation ratios and create a benchmark based on that. So this approach is a bit more granular than what we did earlier in use case 1, but also more precise. And you can do the same thing, not just for valuation ratios, but also for expected returns. So here, the same exercise is done by expected returns. And for asset A, you can determine what kind of average IRR you can expect by these different buckets that you are interested in. So forward-looking yield is about 8.7%, just the average of these 4. So it's a very robust exercise, as you can see here, and there is no restriction on how many buckets you can create. So here I've taken example of 2 individual deals, so FCC Renewables and Humber Wind Farm. FCC Renewables was sold for 10.9x in 2021, which is close to the EV/EBITDA ratio that we have come up using this approach. And Humber Wind Farm was sold for 12.7x in 2021, which is also close to the EV/EBITDA ratio that we have come up using an approach like this. Although the range between lower bound and upper bound is a bit wide, you have a 3x range in there. So there is potential to price it a bit higher as well. But the key thing is that you can do this approach using as many subsegments as you want, by age, by business risk, by risk factors, by time to maturity, by corporate governance, by industry. So all those splits are possible. And you can even create some dynamic buckets. So you don't have to standardize, say, 5 buckets for size factor. You can look at the size of FCC renewable project and create buckets based on that. So that could be a dynamic classification. Now, I guess in the interest of time, I'm going to skip this poll. We were going to ask you that out of these 2, which investment would you prefer? One is cheaper and has some higher expected returns. The other is a bit more expensive, lower returns, but it could also have higher exit potential because its upper bound is a bit higher.
I think we should have the poll because how you've presented it, and it will be quick because this is so interesting. So basically, what you're saying is that if you can super leverage all this data in order to get something that in the end, because of the average of the average of the average of each aspect of those companies, you end up with the right price, which is quite powerful.
Okay, Natalia, can you please launch the poll?
Yeah, absolutely. 1 second.
Interesting. So everyone's going for the higher yield asset.
The situation is getting clear now. What investors are preferring here.
Obviously, it depends either what your yield target is or what your price target is. But you would fix one and pick the other best one.
Yeah. Okay, Natalia, if you can stop it, please, at this point and share the results. Okay, so as you can see that majority, 72% of you have chosen FCC renewables and 28% have chosen Humber Wind Farm. So majority of you have gone with the cheaper, higher return project at this point between these two, purely based on these valuation estimates. But as I said, with Humber Wind Farm, there's potential for higher exit potential. So some of you may have looked at that as well when choosing this selection, choosing this project, or depending on what the target yield is that you are looking at. So it's a very interesting exercise. And again, using this risk factor approach and this average of different classification that you have come up with, it's possible to get to an estimate like this. Okay, now, yes, so just to compare, just to recap, what have we learned in the use case 2? When you compare individual asset, it is possible to build comps that are robust, incorporate granular classifications, which look at the TICS characteristics, geographies, risk exposures, and so on. And the law of averages, in fact, works that instead of finding most granular subset of all segments, you basically can find dynamic segments that are truly driven by the characteristics of your assets. So it's a bit more granular than looking at a broad sample overall. You take the averages of averages across these segments, and noise basically gets cancelled out. So you are left with the best estimate possible for that asset. Finally, there's a quick one, use case 3, and perhaps the most complicated one. If you want to value an individual asset, individual deal, if you want to assess the valuation for that deal, here I've taken a motorway in Portugal. It's a merchant business risk project. Reported transaction from September 2021. I have some financials for this project here. And what you're trying to do is assess whether this deal is fairly priced before this investment has happened, obviously. And it requires very high granularity, strict selection criteria for comps. So it's, in fact, we were talking about the spectrum. This is the case where there is a need for granularity because you are looking at individual assets. There is no point about offsetting the idiosyncrasies and so on to some extent. So you can try to go granular. So we have tried to find these comparable assets in infraMetrics. We are looking at their average valuation, average financials from 2021. So it's a very strict criteria that we have followed. We have, at the end of it, we have selected 5 roads as suitable comps out of 112 in infraMetrics. So we have monthly data for those 112, and we could only select these 5 that fit the purpose. And that's based on the country selection. This is our deal under consideration is in Portugal. So we looked at Spain, Portugal, and Italy. So South European countries. Contracted motorways, that's what we are interested in. And finally, we looked at size that's less than 500 million. Leverage that's greater than 50%, profitability that's less than 10%. So we have come up with some systematic rules to match the deal that we are interested in, and figured out that yes, this is the comps that we are interested in. If you take an approach like this, you can arrive at a valuation estimate that's reasonable. So our comps benchmark gives us 24.1 EV/EBITDA. And the deal was priced at 26.2. So it's a bit more expensive, but not completely off from the benchmark. And that's a result of selecting these comps from a very large database at a very with a very strict criteria. That's essentially the key message here in this use case 3, that assessing individual deals is a very difficult task at a high granularity. It requires detailed knowledge of common characteristics, risk exposures, which drive their valuations. And it cannot be done by just recent transactions. We showed you earlier in the example of road, the Italian road. But it is possible if you have a large database of companies with more frequent valuation estimates and a proper classification system. So it can actually help you get to something close for your asset. So on this note, I wanted to introduce this new product in infraMetrics that we are going to launch, I think, next month. So sometime next week, let's put it this way. It's the asset search and due diligence. It's the asset search and due diligence product. So it lets you compare individual assets. It lets you look at the financials of those assets, the valuations, some climate risk data, and so on. So with this product launch, you will be able to do an exercise like this, the deal assessment yourself using this data. So that's what we are going after here, providing you as much granularity as you need while thinking about the robustness spectrum. Okay, at this point, I'll hand it over to Frederick to just go through the key messages that we have covered in the presentation, and then we go to the conclusion.
Right. Oops. Excuse me. I'm gonna have to go through this quickly. By the way, that third case where you do the individual comparisons, it's possible because we have this really large list of assets and you can find assets that are really quite alike, but you do this at your own risk.
I mean, we chose 5 out of 112, so it is a big selection criteria.
Yes, but if you apply the law of large numbers, you should be safer.
Yeah.
Anyway, just to summarize what we've been saying, so all these investments, even though it's infrastructure and it's illiquid and all that, they're made on a relative value basis and as a result of an arbitrage between investment opportunities. It's important to remember this because what that means is that it's their common characteristics that will determine what investment decisions are made. And in the end, it's how you compare things, right? And so all infrastructure investment decisions ultimately must rely on some kind of comp, whether it's DCF pricings, ratios, or whatever. And because we have these very highly heterogeneous assets, finding twin asset or the perfect like-for-like asset is very difficult. And in most cases, it's not going to happen. You're not going to be able to achieve this, right? However, we can develop comps that are good benchmarks of prices, market prices. And in that respect, they can be very useful to make informed investment decisions as long as you rely on the right classification of those common characteristics. Also, you're looking at aspects of these deals which are comparable, and there's enough data in each bucket. And again, as you saw, as long as you can isolate individual aspects and then have a large sample and take the average and then take the average of all the averages, you actually get quite close to the real characteristics or the actual characteristics of these investments, right? And so that's what you can do with this system for 2 reasons. One, because it has a lot of data in it, and the other one because it uses a consistent classification methodology, both the TICS classes and the factor approach, which allows you to distinguish between the size, the leverage, the profitability, etc., of these assets on a systematic basis. And finally, this is important. It will make a difference because without these good comps, without these better comps, you might call it, investors are blind to the reality and the opportunity of the decisions they make to buy, sell, or hold infrastructure assets, which is too bad, really. If you have noisy, unreliable comps, it's not possible to compare these assets when you're faced with a range of possible investments. And I've heard this story many times, like, oh, we have these 5 wind farms. Guess why we picked that example? Which one should we invest in? So it's without reliable comparators, it's very hard to do. If you do have robust comparators, if you don't have robust comparators, you're left guessing what the genuine value of the asset and the best entry price might be. And here again, just looking at recent deals might be a bit of a problem. So talking about renewables again, I've spoken to a few people recently who start to think that renewables are overpriced in Europe. So if you're just looking at the recent deals, you might be getting the prices from yesterday. And maybe that's not what you should be looking at. Maybe looking at risk factors, for example, might be more interesting. Yeah, so it's important to make sure you're looking at robust data. Another reason why it's important is because the market value, the fair market value of these assets is becoming increasingly a concern for the regulator, in particular DC pension plans, where individual investors can switch. At which NAVs should they switch? They switch sometimes on a daily basis. So in this context, using robust comps becomes a fiduciary question. Is it fair to individual members how values are being assessed? And in the same way, it becomes a matter of the quality of the due diligence. If you're using robust and systematic framework, you can guarantee the quality of your due diligence, for example, when you co-invest. Otherwise, you're left with, well, actually not that much to know why you're making the decisions that you're making, right? So thank you for your attention today. I just wanted to point out that in 1 month, on the 20th of March, we'll have the second part of this series where we'll focus on fair market value assessment. You can register on our website or you can contact us to do so. And between now and then, thank you, and we'll see you around.